Now, in my opinion, even better than mutual funds or even index funds are index ETFs. ETF stands for Exchange Traded Fund. It's like a mutual fund in that it holds a bunch of stocks, so it's diversified. It's like an index fund in that it's not managed, has low expenses, and tracks an index. And what I like about it is that it trades like a stock. A mutual fund can only be bought or sold after the market has closed for the day. So if some bad news comes out, like, I don't know, say the entire financial system is on the brink of collapse due to a jillion failed mortgages, like that'll ever happen, you can't sell until after 4 p.m. that day. An ETF can be bought or sold at any time the market's open. So if you're at work and you hear that the market is tanking, you can sell your ETFs and get out right then and there, if you want to. Subsequently, if the markets are down but some good news comes out, you can buy an ETF before the market rallies back at 3:30 in the afternoon. I'm starting to sound like a trader now, so I'll stop. Just know that an ETF lets you do these things if you want to. You don't have to. Actually, one more very important thing about ETFs. You can typically buy a mutual fund commission-free when you buy them online, but most ETFs you have to pay a commission. This matters because if you're buying investments once a month, you're paying a commission each time you buy or sell. Those commissions really add up fast. The ETF people realize this, and now there are a bunch of zero commission ETFs out there. I'm telling you, these things are great for long-term investors who are making regular periodic contributions to their retirement accounts. These are what I recommend the most for you when you start investing. Zero commission index ETFs. They kick ass. So here you go, my official recommendations. Realizing again, I'm not telling you to do this. You cannot sue me. All right. For large caps, the IVV ETF, which tracks the S&P 500 index. For mid caps, IJH, the S&P Mid-Cap 400. And for small caps, the S&P Small Cap 600 IJR. As you might assume, IVV has 500 stocks in the index, IJH has 400, and IJR has 600. Pretty darn diversified, huh? For international, I like the ETF EFA or ACWX. For emerging markets, EEM. And for a bond fund, I use MUB, which is an index that tracks municipal bonds, and HYG, which contains corporate bonds. For cash, I just use a money market fund. I happen to have my investment portfolio with Fidelity Investments. This entire list is all zero commission ETFs that I can buy through them. I also have some managed mutual funds, some non-index ETFs that invest in certain sectors, and some individual stocks. Those are my plain money buckets. You can choose to supplement your portfolio as you'd like, or you can just own these 7 investments. Since there's no commissions or fees, you can buy $10,000 worth or $10 worth. Any dividends or capital gains paid by the funds get reinvested back in, so your money compounds over time, growing all the while. Dividends and capital gains are basically payouts that the investments give you just for owning them. They get paid out in various intervals and are pretty damn cool. And what about the play money I talked about? If you're interested in playing stock picker, feel free to set aside some money to buy a stock or ETF with. Do your research and only use money that you can afford to lose as your play money. Picking and owning a stock requires you to learn more about that stock or company than owning an index fund does. What's its PE? How much debt does the company have? How does the company compare to its peers? Who are its peers? Is its price currently in an uptrend or a downtrend? Is it the sector trend up or down? If you don't know this stuff, you probably shouldn't be messing around buying the stock. Okay, so now you know about asset allocation and what you can buy to fill out that allocation. So now the question is, how and when do I invest? There was a time when I stupidly thought that the stock market just went up all the time. I first got into the market in the late 90s, when it seemed like every day stocks were hitting new highs. I thought this was the greatest thing ever and couldn't believe nobody had told me about it before. Turns out it was just a bubble forming. That's when something is inflating and everything is going well. Everyone else hears about all the money being made, so they rush in to buy as well, which just accelerates the hysteria. Then one day the bubble pops and the markets crash. like with internet stocks in the late 90s and the housing market in 2008. If you were one of the people late to the party, then, as I've heard stock market people on TV say, you got your face ripped off. Ouch. Doesn't sound good, does it? Lots and lots of people will claim that they have the tried and true method to timing the market, or that they have a software program that has all the answers. The market has tells that signal when to get in and when to get out. Don't you think that if it were that easy, everyone in the world would be a billionaire by now? One of the biggest temptations is going to be to try to time the market. I'm telling you, it's really, really, really hard to do. And often you end up hurting yourself more than you help yourself. I know it looks easy. You see a chart like this one and think, oh man, what if I had bought here, then sold there, then bought again there, and sold again there? I would have made so much money. It's easy to look at a chart of the past and think that. In real life, and real time, however, it's not that easy. The problem is emotion, fear, and greed. When the market is screaming higher, it's really, really tough to sell. Like doing well at a blackjack table, it's hard to get up and leave when you're ahead. And when the market is crashing and the news reports are all talking about how all doomed we all are, it's really, really hard to buy. Let's look at an example. So here's a chart of some nameless stock that I got from Yahoo Finance. Say, for example, you decide to buy the stock for whatever reason, and you buy it here, around 38 bucks a share. Let's see what happens. Okay, cool. After a little while, the stock price is up and you have a bit of a profit. What do you want to do? Sell now and lock in that profit? Or do you want to hold on for more? Maybe you want to buy some more shares here. You're at a blackjack table and you've hit a few hands, so now what? Let it ride or cash out? Let's say you decide to hold on. What happens next? Hey, nice job. We're up around 48 bucks a share now, better than a 20% gain. All right, Richie Rich, what are we going to do now? Things are going pretty well. Letting it ride was the right choice last time. Say you decide to hold. Ah, crap, the stock fell, but you're still above where you bought it back in September. You had a good-sized profit on your hand. You had been up about 20%. Now you're up about 8% or so. You remember what it felt like when you were up 20%? It felt good, didn't it? Damn good. 8% doesn't quite feel as good, though. Like at a blackjack table, it's not quite the same thing being up 50 bucks when just an hour ago you were up 500. Maybe now you buy more, figuring, hey, we were at 48 bucks a share not long ago. We'll probably go back there, right? Well, now this really sucks. We're lower than where we were back in September, and buying more has only accelerated our losses. So now what? Cash out now, take the loss, and stop the bleeding? Hold on to see if the stock comes back? Unfortunately, this is where the chart ends, so I can't tell you, because I have no idea. And if anyone thinks that I just made this chart up and it's not a real stock, nope, it's actually a one-year chart of Hewlett-Packard, the company that makes computers and whatnot. So hopefully this example illustrated some of the reasons why timing the market is a really hard thing to do. So what do you do?